World oil and gold prices increased slightly last week as geopolitical tensions in the Middle East escalated, pushing investors to seek safe havens, and businesses evaluated signs that short-term oil supply tightness. Oil prices increased slightly. Oil prices on February 21 increased slightly by 1% as geopolitical tensions in the Middle East escalated and investors evaluated signs of short-term supply tightening. WTI light sweet oil price increased 87 cents, equivalent to 1.1%, to $77.91 per barrel, while Brent oil price increased 69 cents, equivalent to 0.8%, to $83.03 per barrel. The price difference between short-term and later-delivered oil contracts is at its highest in recent months, a market structure known as contango, or contango forward curve, and is considered a sign of a tight market. UBS analyst Giovanni Stanovo said the forward spread strategy shows that markets are tightening, and the amount of oil and crude oil reserves at the Amsterdam-Rotterdam-Antwerp trading center is decreasing. Meanwhile, inventories of petroleum products also fell in Fujairah last week. Another factor supporting the market is that U.S. oil refineries are showing signs of returning to operation after a maintenance period, when operating capacity dropped to the lowest level since December 2022, boosting crude oil reserves. Energy analyst Alex Hodes at financial services company StoneX stated, recent refinery shutdowns have caused crude oil inventories to increase globally, but as these refineries can resume operations, which will put pressure on the difference between crude oil prices and refined oil product prices. Gold maintains its high price. Tensions that show no signs of cooling down in the Middle East are also causing investors to seek the safe haven of gold. Meanwhile, the latest meeting minutes of the U.S. Federal Reserve, Fed, have reduced hopes that the bank will soon cut interest rates. At the end of the trading session on February 21, spot gold price increased 0.1% to $2,026.21 per ounce. At the beginning of the session, the price of this precious metal sometimes increased to its highest level since February 9. Meanwhile, U.S. gold futures prices decreased 0.3% to $2,034.30 per ounce. Mr. Jim Wyckoff, senior analyst at gold market site Kitco Metal, said the conflict between Israel and Hamas forces remains tense, causing gold to maintain its high price. Gold is seen as a hedge against economic and geopolitical uncertainties, while higher interest rates reduce the appeal of holding gold, which does not yield returns. Most policymakers at the Fed's most recent meeting were concerned about the risks of cutting interest rates too soon, with uncertainty over whether borrowing costs will remain at current levels in the near future. How long? That has reduced hopes for the Fed to cut interest rates soon. Mr. Daniel Pavalonis, senior market strategist at commodity futures trading company RJO Futures, commented, "The Fed will not cut interest rates or raise interest rates, so I think gold has the potential to increase in price in the near future." Short term. Also on February 21, the USD index decreased slightly, making gold, which is priced in greenbacks, more attractive to foreign buyers. Scenario of strong increase in gold and oil prices. Analysts from Citibank, USA, recently commented that gold prices could skyrocket to $3,000 per ounce and oil prices will reach $100 per barrel within the next 12 to 18 months, if anything happens. Any one of the following three catalysts appears: central banks sharply increase gold purchases, the risk of stagflation, or a deep global economic recession. The most likely path for gold prices to reach $3,000 an ounce is a rapid acceleration of an existing trend, said Akash Doshi, head of North America commodity analysis at Citi and Associates. But progress is slow, de-dollarization in central banks of emerging markets, thereby leading to a crisis of confidence in the US dollar. Citi said gold purchases by central banks have surged to record levels in recent years as they seek to diversify reserves and reduce credit risk. China and Russia's central banks are leading gold purchases, while India, Turkey, and Brazil have also increased bullion purchases. Last January, the World Gold Council estimated that world central banks had maintained 2 consecutive years of purchasing more than 1,000 tons of gold. Mr. Doshi expects that if this number doubles to 2,000 tons, gold prices will receive a strong boost. Another factor that could push gold prices to $3,000 per ounce is a deep global economic recession, which would prompt the Fed to cut interest rates quickly. However, Mr. Doshi noted that this is a low probability scenario. Gold prices tend to be inversely proportional to interest rates. As interest rates fall, gold becomes more attractive compared to fixed-income assets such as bonds, which will offer lower returns in a low-interest rate environment. Stagflation, a condition in which inflation is increasing while economic growth slows and unemployment increases, could be another catalyst for gold prices to skyrocket. However, Mr. Doshi believes that the possibility of such a scenario occurring is very low. Another scenario mentioned in Citi's report is that oil prices return to three-digit levels. Mr. Doshi said the catalysts for oil prices to reach $100 per barrel include higher geopolitical risks, production cuts by the Organization of the Petroleum Exporting Countries, OPEC, and its partners, and disruptions. Supplies from important oil-producing areas. However, Mr. Doshi forecasts that oil prices will be around $75 per barrel this year.